Hmm. So you're a founder and you're asking yourself when is the right time for you to approach a venture capital firm and actually get them to write you a check for your business. In this video, I'll be explaining the nuances around the life cycle of a VC fund and help you to understand how that affects the perfect timing for you to approach a VC firm and actually get them to back you. So if this sounds like something that you're interested in, smash the subscribe button and let's get started. Hi there, welcome back to this YouTube channel. My name is Miracle Naji, and if you're just joining this YouTube channel for the first time, I started off my career as a management consultant and currently I work as an investment professional within the venture capital space. And currently I've been running a venture capital series that is aimed to help you as a founder to really understand all of the different nuances within venture capital so that you're able to stand a better chance of getting funded by venture capital firms and also getting to work with them better. So if you are just meeting this video for the first time, you may want to check out my earlier videos. It's really going to help you a whole lot. But in this video, I'm going to be focusing on talking about when is the appropriate time for you to approach a venture capital firm for funding, right? And there are a lot of considerations that go into this. So I'll start off by saying that most VC firms will definitely have a lifespan, usually 10 years, and on average is about 10 years, with an option to extend the fund life by 2 to 3 years. Now, before the fund life starts, there is usually this period of fundraising, and then there is investment, there is the part of portfolio management, and then there is the part of exit. So without wasting much time, I'm just going to go straight in. So there are four different aspects that is very, very critical that you need to know. So the first part is fundraising. I had mentioned in one of my earlier videos that the distinguishing characteristics of VCs is that they do not invest their own money. They tend to raise money from a class of people that we call limited partners, and these limited partners, they could be high net worth individuals, they could be institutional, they could be a corporate organization, they could be a fund of funds, they could be several organizations, right, that tend to provide funding that the VCs will eventually use to invest into companies. So what that means is that if you're approaching a VC firm at the period where they're actively fundraising, most of them at that particular period in time, they may not be actively writing checks, right? Because at that moment, they do not even have money to invest. So they are still fundraising. And you find out that the typical fundraising timeline is between 12 months to around 18 months, but it all depends on prevailing market conditions at that particular point in time or the performance of the fund manager. Again, most emerging fund managers find it more difficult to raise money from limited partners. So for them, it's going to take a longer time. So what is very critical for you to note here as a founder is that at that particular period of fundraising, they may not be actively writing checks, but most VC firms would be actively seeking deals, having due diligence, and speaking to founders. Reason being that they need to build a pipeline of deals that they are going to be showing to their limited partners to say, okay, look, I'm raising this money, and if you give me this money, I have this number of deals, good deals that I've looked at, vetted, and I'm able to deploy the capital into those deals. Because one consideration of limited partners when they are looking at fund managers for potential investment is, does this person or does this fund manager have enough good deals to be able to deploy my capital? Because most people know that the extent to which your fund is able to perform all depends on the amount of good deals that you're able to have. So at this particular phase, you would want to do your research on that particular VC to know, okay, where are they on their fundraising timeline, right? Are they, when is the indicative time to close or maybe reach a first close? And these are information that are not publicly available. So you may want to reach out to some people that work within that VC firm to have an understanding of where they are on their fundraising journey. But like I mentioned, the critical thing for VC firm is that at that particular point in time, though they are not actively writing a check, but they are also going to be speaking to founders, and once they're able to qualify and vet a deal, they tend to warehouse that particular deal. So post their fundraise, they are going to be prioritizing those deals that they've already looked at and warehoused for that particular fund. So it's a very, very important time for you to also reach out to VC firms, but we note that they are not actively writing checks. So one thing you want to double down on is research. Research that particular VC firm in depthly. So the next part is that once the VC now raises a fund, then the next part for them is now investment. So typically a VC would have about 3 to 6 years during which they're able to deploy the capital that they have raised. Right. So at this particular point in time, they are actively writing a check, and this is the most perfect and best time for you to also reach out to this VC firm, because at this moment you have a chance of them writing you a check. But then again, your research is very, very critical. Your research is very, very critical because your chances of getting an investment or your chances of getting an allocation from these different VC funds will be affected largely by the VC fund portfolio construction. When I talk about portfolio construction, what do I mean? So the first aspect that affects their portfolio construction in terms of the fund size, how much have they raised? So there are some VC funds that we call micro funds. Well, in more developed world like in the US, micro funds will be somewhere around $20 million, $30 million. But really, when it comes to Africa, like $20 million is actually a large fund, right? Because we mostly see most VC firms now, the fund they are raised is usually less than $10 million, right? So you want to know what is their fund size, because the fund size of that particular VC firm to a large extent is going to affect the number of deals that they're able to do, is going to affect the check size they are going to be writing. So the fund size is very, very critical. So if you're approaching a micro VC, if you're approaching a micro VC fund, you will definitely know that they are constrained on cash, and the number of deals they are going to be doing will be very limited. So your chances of getting them to close a check on you would be much slimmer. Then another part of their portfolio construction that you need to pay attention to is their sector focus. So some VC funds are sector agnostic, some VC funds are specialist funds. What that means is that if you are, let's say you are a health tech founder and then you're approaching a generalist fund, most of these generalist funds within their portfolio construction, they may have a number of investment that they want to allocate to a particular sector. So for instance, health tech, they may have, let's say they want to do only one deal, they want to do only two deals. So what that means is that as a health tech founder, the competition is for you to be one of the two health tech companies they are going to be investing in is going to be much more intense, because every other health tech company only have two slots. So what you also now find is that you've approached a VC firm and they are telling you that they have already exhausted the allocation that they want to make to health tech, right? As opposed to, let's say, a specialist fund that maybe has a specialized focus on health tech companies and then free tech companies. You see that they are a specialized focus on health tech. You see that the allocation to the health tech sector would be larger. So this time around, their own portfolio construction will be around, okay, what sort of vertical they want to do in health tech. Okay, I want to do pharma tech. I want to do telemedicine. I want to do biotechnology. I want to do biotechnology and all of that. So it now has to do with which particular segment in the health tech that you are playing in and what sort of allocation the VC firm has for that particular segment. So understanding the sector focus of the VC firm will definitely impact on the ability to get them to write you a check. And also we have talk about the stage they are focused on, right? And I've mentioned this in my previous video that some VC firms invest across all stages. Some invest tend to focus on just early stage, some focus on growth stage, and some focus on late stage. So what we find is that most people that are focused on late stage, because late stage funding is one that requires larger capital, larger ticket sizes, you see that most of them tend to write fewer checks, right? So at the late stage, you see maybe the person has raised $20 million and they're only doing, out of the $20 million, they're only going to do 5 deals, they're only going to do 6 deals, because for most of them, they will either be leading the round or participating in the round at very high valuation. So the checks that they need to write has to be high. Right. So that tends to affect the number of deals. So it means that the number of allocation, the number of deals that they are going to do will be smaller and the rejection rate is going to be higher. But for early stage investments, especially in this space, we tend to find that most of them follow a spray and pray strategy. When we say spray and pray, is that they tend to write smaller check sizes and invest into several startups, right? So for early stage investors, they tend to do more deals. Again, another part of the portfolio construction, like I mentioned, is the check size that they are going to be writing. So most of them will want to follow a strategy of writing small check sizes and investing across several deals. Based off on that understanding that most times the risk factor involved in a startup failing is high. So because sometimes they may not know the startup that would succeed or the startup that will fail, they want to invest across several and then monitor them over a period of time such that the ones that are losers, they're able to write them off quickly and then double down on their winners. So that brings me to the next part, which is the follow-on reserves. What we tend to find with certain VCs as well is that they do not deploy all the capital that they have as per initial investment. So sometimes they would want to reserve a particular amount of the fund they have raised as follow on. So sometimes for maybe 40% of the fund that they have raised. So what that follow on does is that after the initial investment that they have made, like I mentioned, most times you may not know the startup that will eventually turn out to be your winners. So they invest after the initial investment, then subsequently in subsequent rounds when the startup is going to be needing further funding and they have identified the startups to be winners, they double down on their investment by providing follow-on funds to the startup, right? So at this particular stage for you, you stand a better chance for at the investment period, which spans 3 to 6 years, you stand a better chance of closing a fund, getting them to write you a check. But you have to do your research properly to understand the portfolio construction, to understand the strategy, the investment thesis of that particular VC firm so that you stand a better chance. And again, most of this information may not be available online. So you may want to network, speak to people that are working within that VC firm, speak to other startups that have received investment from the VC before just to gather more information as to their approach. Then after investment, right, like I mentioned, we span 3 to 6 years. So most VCs now enter into a phase of portfolio management. So at that portfolio management phase, more of what they are doing is portfolio monitoring and reporting. So checking up on these different startups and understanding where they are on meeting some of the growth milestones that they mentioned. So at this particular point in time, they are very much heavy on value add activities because one of the distinguishing characteristics of venture capital firm is that they don't just provide funding, they also provide hands-on support to support the startup founders, right? So you see that at that particular point in time where they have deployed all of their different investments, you may not have a chance or except they have started raising, let's say, a second fund, right? At this particular point in time, they may not be actively writing new checks. So they are just monitoring the current investment that they have made. So that's why sometimes you approach a VC and they tell you that, oh, they have exhausted their capital allocation. Oh, their capital constrained, right? So at this particular point of portfolio management, most of the investment that they are doing will now be follow-on investment, like I mentioned. So at their winners, the winners they have identified in their portfolio, participating in subsequent rounds, investing to those companies, but not necessarily making new investment. But sometimes you may have VC firms that raise a large amount of money, and perhaps at that initial investment phase, they were not able to exhaust deployment because there were not enough good deals. So some of them may have dry powder that they're going to use to do more opportunistic investments. So if you are lucky to have such a VC firm, then your chances of raising a fund from them also increases. Then the last part is now divestment of for a VC firm, right? So no VC is going to stay in the company forever. So they expect to divest their investment, they expect to exit their investment after a particular period of time, right? So at the period of exit, they are writing off losers, so companies that completely failed, they're writing them off, and then they also seek exit in terms of mergers and acquisition, IPOs, and secondaries, right? So that's what they do majorly at the period of divestment. So when it comes to actively investing in new funds, right, they may not be doing that. So with that being said, it means that the best time for you to actually position yourself to get a funding from VC firms is one at that period of fundraising, especially at that period of fundraising. Most of them are trying to build out their warehouse of deals, build out their pipeline of deals. So though they may not be actively writing check at that particular point in time, but you stand a better chance if you are warehoused into their fund. You stand a better chance of them investing into you when they eventually close. But the most important time when you have to reach out is when they're actively investing. And like I mentioned, they would have about 3 to 6 years post their fundraise to deploy capital. That time they are actively writing a check. But you need to do your research properly to understand their portfolio construction. So that is it about the perfect timing to approach a VC for funding. In subsequent videos, I'm going to be doing a more deeper dive into the nuances around venture capital. So in case you found this video very helpful, once again, hit the subscribe button and don't forget to come back, set up your notifications, and don't forget to come back to view subsequent videos. Thank you very much.